No, I think you summed it up pretty well. We think that 2022 is going to be an okay year, like 9, 10% for stocks. But being that you're starting right now down 8 to 10%, we think it's going to be up a lot from here. We'd be buying days of weakness. We would not be chasing days like today.
Okay, what are the names you're most excited to buy here where you still see pretty good value?
We think there's a lot of excellent value out there. We would use a barbell right now with some value and some growth stocks that are at value prices. On the value side, we like names like Goldman Sachs, U.S. Bancorp on the financials, which just had pullbacks. Medtronic is a medical device maker. We think it's selling at a compelling price right now. We're probably going to have a little bit light quarter, but we think 6 to 12 months from now, we expect the stock to be a lot higher. The three stocks that we just gave easily should have 20 to 30 to 40% upside this year.
Wow.
We then balance that against some of the growth stocks that have come down, and we like Facebook and Google. And Thermo Fisher is a great company, 15% or better growth over time. It was at 29 times earnings earlier this year. It's at about 24 times earnings right now. We think this is a great time to buy that sell-off.
I'm trying to recall if I asked you about Netflix recently, if you were one of those who preferred Disney over it. But broadly speaking, in sort of the rest of the FANG space, what are the other ones attractive to you? We're going to hear from Alphabet. We're going to hear from Amazon reporting this week.
So we like Microsoft. They had a great quarter last week. We think that stock easily has 10% to 15% upside this year, and then we'll continue to do well over time. We've not been a fan of Netflix. We spoke a few weeks ago. We said we didn't like it. We preferred Viacom and Comcast.
That's right.
At this point, in light of the very sharp sell-off in Netflix, we're probably okay with it now. You had the CEO bought $20 million worth of stock. And there have been some smart, active investors involved with it. So we think it's probably okay, but our preference is Comcast and the Viacom.
What do you make of the flattening yield curve, which to me feels like the one big, I don't know if we call it a sword of Damocles, but it is certainly hanging over the optimism about financials right now. It is hanging over the hopes for the growth outlook and everything that the Fed intends to do. What do you say to people about what we're seeing, especially in the 2s and 10s?
Well, we think that interest rates are going to be going up this year, and it's going to be going up on the short end, and we think it also is going to trend up on the longer end. So we wouldn't read too much into a 1 or 2 week move in terms of a flattening of the yield curve. We think financials, which did great last year, are positioned to have a very good year this year. They're going to benefit by a rise in rates. We think if it's a steepening yield curve, that even makes it that much better. But a rise in short-term rates is going to help a lot of the financials. A company like Bank of New York or State Street also a significant beneficiary from that. And in terms of the growth stocks, we think if you can buy the growth stocks at a good price, under like 20 times earnings, you're going to do fine. But what we very much are wary of are the 50 and 100 times earnings growth stocks.
Sure.
If you look at some of the growth indexes this year, they're down about 15%. There's some really smart growth managers that are down 15%. We think there are opportunities in those. We think value is going to outpace growth this year, but growth started so poorly that we think you can dip your feet in that. And the other part, and we don't traffic as much in this as in small cap stocks, they've sold off huge this year. We think they're going to do better from here. And in that case, we would probably stick to some small cap ETFs like a Russell 2000 or the S&P small cap index rather than picking individual stocks, just because we don't know them as well.
Interesting. So let me go back just before we close. You think the yield curve basically will re-steepen, that long end rates will move higher. Would you sell your financial holdings if that doesn't happen?
No, we think that there's so many good things happening with financials right now. They're going to benefit by an improving economy. The balance sheets are in great shape. The loan portfolios are in great shape. And yet they're selling at 12 times earnings to the market that's at 21 times earnings. So we think a steepening yield curve just is the icing on the cake. But for a lot of them, just the Fed raising rates is going to help them very significantly. So we think they have the wind at their back after almost a decade of the wind at their face. So we like them a lot. And there are lots of different things within the financials. So we like the Goldman or a Morgan Stanley. And then we like the pure banks like a JP Morgan or a U.S. Bancorp or a Truist.
All right. Sticking with them, hoping for that curve to behave itself, but sticking with them nevertheless. David, great to have you here today.
Yes.
Thank you.